Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 7th of April. I'm Daniel Lam, your host for the podcast. Now, I will not be talking about more details of the Liberation Day, since most likely you have read about them in various reports. I want to concentrate upon giving you various snippets to help you navigate these volatile times. First of all, I strongly suggest you to listen to the latest Invest Tips from the CIO's Desk podcast by Steve Bryce, our Chief Investment Officer. It is a special episode on navigating volatility. Now, there is some valuable advice and wisdom there, but the essence is to stay calm and appreciate that, first of all, volatility is a normal state of affair for the markets. Secondly, the longer you hold investments, the more likely you can generate positive returns. And thirdly, buying after periods of market weakness generally improves forward-looking returns. So let me talk about some statistics. Since 1970, we have seen 24 instances of the S&P 500 index correcting by more than 10% from its all-time high. Now, such corrections were followed by recession in the next 6 months in 7 instances. After a correction that is followed by recession, the S&P 500 would go on to deliver an average return of 2.3% and 1.9% over the following 6 and 12 months. Now, if the correction is not followed by recession, the average returns are 10.8% and 14.4% over the next 6 and 12 months. So unconditionally, the S&P 500 would give an average return of 4.6% and 9.4% over a 6 and 12 months period. Now, moreover, intra-year volatility in the S&P 500 is not uncommon, even during up years. So right now, to put in perspective, the year-to-date largest intra-year gain and the largest intra-year decline is well within what we saw over the last 25 years. So in other words, according to the backtesting, it makes sense to be buying equities after the market drops. But of course, the narrative of fear comes in. For example, is the US going into a recession? Or worse, are the tariffs and trade war pushing us into a 1930s scenario? Well, to us, the comparison with the Great Depression is not valid. The Great Depression was caused by 3 factors. First of all, the widespread imposition of tariffs. Secondly, the irrational exuberance in equities over the preceding 8 years. And thirdly, the gold standard meant monetary policies remained very tight. So fast forward to nearly 100 years after, we have a common factor in that the imposition of tariff is widespread, but the other 2 factors are not the same. So for example, S&P 500 index was up 165% in the most recent 8 years, in 2017 to 2025, compared to 467% up in 1922 to 1930. And also, central banks nowadays have full flexibility to respond to economic conditions. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.